All right, we're live. Boom. There's no intro. There's no nothing. Like we just went from 0 to here we are in 2 seconds because you know why, Jen?
We don't need an introduction. We don't need an introduction.
Because we're really half-assing things today. That's why. Because I have my whole week and last 2 weeks have been nuts. We've been really busy, so that's really good, right? I mean, you're over there on your phone right now dealing with an issue, probably handling something, and I've been on the phone. We've been locking loans and closing loans, and it's been awesome. But it just makes for all the extra stuff that we try to do gets a little bit pushed to the backside. So that's kind of why we're half-assing it today. Some no intros. I didn't get it already, but you don't need it because we're getting into nuts and bolts on this stuff anyway. Yeah. All right. Hello, everybody. Mike Mills with Verity Mortgage, and this is Jen Gaudio joining me today, also with Verity Mortgage. This is the 42nd episode of the Texas Real Estate and Finance Podcast. And yes, 42. I did 42 of these suckers. I know it's crazy, right? And I think I've had like 5 people watch, so it's been awesome. No, I'm kidding. I actually have on my YouTube channel, I have over 1,000 subscribers now.
Do you really?
I do indeed. Yes. So anyway, today we are going to get into some nuts and bolts on mortgage stuff. We're actually going to talk about a lot of special loan programs that are available out there. I say that with a wink because I got a little side note on that. We're also going to get into specific loans and talk a little bit about qualifications for like FHA loans and what's required for appraisals and what conventional loans look for, self-employment, just anything that is kind of a gotcha, get you. One of the things that we always work to is we're trying to solve problems every day on loans. And there's a lot of problems that come up. They're not unsolvable problems. There's just every single loan has something that pops up that you have to deal with, right?
Yep.
And a lot of things can be avoided if you handle things right before you get to that point. And then a lot of things you just have to handle in the moment, but you still got to be nimble and be able to close stuff quickly because at the end of the day, regardless of the problems, what's our number one job, Jen?
Close loans.
Close loans. And close loans, there's an extra
on time too.
On time. Yeah. There you go. That's the idea. Close loans on time. So as we're going through this, we'll start in a couple places, but if anybody has any questions, if y'all have specific scenarios that you want to ask about, just type them in the comments. We will make those a priority. So if a question comes up, we'll certainly answer that.
In the home buying process.
As we go. Anything in the home buying process, any agents out there that have questions about deals that you're working on already. My favorite one is I'll get calls from agents from time to time that say, I talked to the loan officer on this deal that we're doing. They're like a listing agent or something. And they said, it's been in underwriting for like 5 days. And, they're waiting on the underwriter to come out. And I'll say, well, it doesn't take 5 days to underwrite a loan. No. So if it's been 5 days, there's probably an issue.
Something else going on.
There's something going on that you're not hearing about. And so it's just little stuff like that if you don't do what we do every single day, you don't know about this stuff. There is a little bit of decoding. So hopefully we can answer some of those questions, but yeah. How are you today, Jen?
I'm good. I'm ready, excited, busy.
Okay, good. I had to pull her away from this. I'm sure our boss man will see this and be real happy about it. But sorry, Steve, this is just how it's going to be. She's helping me right now, right? So Jen is not an underwriter, but do you have one certification? Am I crazy? You just don't have your DE or am I?
No DE, no SAR.
Okay.
I can underwrite conventional loans.
There you go. That's what I was thinking. You can underwrite conventional loans, but you do have to have a certain license to underwrite FHA loans, which she hasn't gotten. But to say that she knows a lot about how to do that would be an understatement. She knows a ton about this and spends most of her entire day checking guidelines, finding creative ways to be able to get loans done. Like that is basically her job, is solving all of our problems every day. So thank you for that.
I'm the walking guideline.
That's right. Yeah. All right. So first thing I want to start with is special loan programs. So one of the questions that I get every single day, just about when I talk to somebody, is what kind of the most prevalent one is what type of first-time home buyer programs are out there? Number one. Number two is what kind of special incentives are there out there for me as a teacher, doctor, anybody that's in the service world, or I should say like what they would call a hero, maybe. And then the third one is I don't have the best situation in this part or this part, but I have a lot of money, let's say. Like I got a lot of cash. So my credit's not great, but I got a lot of cash. Like, so surely there's something I can figure out, right? So everybody's looking for that special thing that's just there just for them. And there's one in particular we'll talk about called CRA. I'll let you explain what that is. That's especially right now very, very prevalent. You see these everywhere. Every loan or every mortgage bank in the country is splattering all over social media about their 0 down, low interest rate, no mortgage insurance. Like, why isn't everybody in the country doing these loans?
Why isn't everybody doing it?
Why isn't everybody doing it? So let's start there. Let's start with the CRA. Tell everybody what that is.
So in essence, in layman terms, what the CRA is it's basically the government saying you have these big banks and they're like, hey, you have an allotted amount of money
right
in these high minority saturated areas.
And when you say big banks, it is depository banks. So banks that actually have checking accounts and savings accounts. We're a mortgage bank, by the way. So we don't have checking savings. We don't do car loans. We just do mortgages. Okay.
Yep.
So, and there's actually, I would say the vast majority of mortgage loans in the country are done by banks like us.
Yes.
Would you agree? Is that accurate?
Well, that do them well.
Well, certainly that. But I think the market share is, I think it's almost 70% or something like that of independent mortgage banks is what we're called IMBs.
Okay.
So these companies that offer these CRA credit or Community Reinvestment Act loans are depository banks. They have to be.
Yes.
Okay.
And the government basically comes in and says, we're trying to help. We have all this money that's allotted in an annual budget.
Correct.
And we have to spend all this money to help areas, communities that are highly saturated in minorities to try to build that area and try to give home ownership like a goal.
Yeah, they're trying to make affordable.
And they have to spend
options.
this money. They have to, or they get penalized.
Right,
And they got to spend this money.
Yep.
So that's what the CRA program is right now. Basically, if you're in a certain area.
And how are those areas defined usually? And that's I'm asking it as a vague question because I think it is kind of vague. They get to determine.
It's based off of the census,
right?
So the census will come out, I think, again next year, right?
Yes. I don't know.
I think it's next year.
If I had somebody with the internet real quick, I'd have to look it up. I don't know.
I think it's next year.
Okay.
But when the census comes out again, then they'll reassess all of these different census tracts again,
right? Which
is these little your city is in a census tract,
right?
And so what they do is they go into the census tract,
see what the demographics are,
yep. And if it's over, it's got to be highly saturated in a minority, in minorities, in order to even qualify for this type of.
Is it just minority or is it low income too? Areas.
From the majority that I've heard, it's pretty much. Mostly minority.
Okay, so if you have a minority saturated area, that's the ones that get the most attention.
That's the biggest thing.
Gotcha. Okay.
And so there is that type of program. Yeah. That, if you will, so what they're trying to do is they're trying to help these communities. And that's right. That's what they're trying to do.
Yeah. Now, they're trying to get people to get home ownership there.
There's always caveats to it.
Yes.
Okay. It's never like
free lunch.
No.
Yes.
For the CRA program, you got to be in a particular census tract, a particular city area, whatever it is. And within that census tract, which sometimes is kind of crazy because you might find a census tract where you're like, no, I know part of that city is definitely not highly saturated. Right.
But the houses, the address actually has to qualify for it. Yes. Is a big part of it, right? So you can't just buy any house anywhere. You have to buy a house in that area.
In that census tract. Every address follows inside a census tract per county, basically. Correct. So yes, that is a very popular program right now. We have it too.
Yes.
We just have it in obviously certain areas.
Yes.
The Houston area is huge right now. It's pretty much almost every census tract in the Harris County, Waller.
Yep.
Every area in Houston down there. Lots of areas in Louisiana, Mississippi, Florida.
Yes.
But yeah, not anything here locally.
Well, there's not very many areas in the DFW area that would fall into that category. Correct. Because it's a good mix of people everywhere. And there isn't any one particular area that's overly concentrated with any minority group for the most part. I'm sure there's exceptions to that, but for the most part, you don't see that as much up here. But the thing is why these programs are so widely touted, let's say, is because it's very much become a marketing ploy to some extent, right? And what I see often is and it's all over social media. You'll see it on Facebook, you'll see it on Instagram, TikTok, whatever. There'll be a mortgage bank like us, very similar, that'll say, hey, we've got this 0 down payment, which it is, low rate compared to market average, which it is. No mortgage insurance.
No mortgage insurance that you're throwing away every
which
year.
There isn't, right? These are all great things. Like, these are fantastic. But you got to understand that there is a catch. And the catch is that it has to be a house in a particular area.
Yeah. But not just, so like for us, yes, that particular program, the majority of the caveats is really like, the filed returns that you're filing,
Yes.
the area that you're in. But like there is a similar program that has been advertised all over the place by a very big bank.
Okay. Yeah. You were telling me about that.
In America.
Right. So it's a big bank located in America. Okay. So it's an American bank.
Yeah.
So you could say it's bank, some sort of a bank. Okay. Gotcha.
Yeah.
I got you.
And they have the same program, except that program. And I've actually called to try to I wanted to find out more about it because I'm like, man, it can't be this simple because you see it all over the place.
Yeah.
So I called then you find out there's like months of home buyer courses you have to do. And then you have to fit into like this little tiny box.
Yes.
And if you don't fit into this little tiny box,
can't get it.
You can't get it.
Right.
But then what happened?
You already came under contract with a house.
And you're there with this big bank that's here in America, who's not known for closing loans on time,
right?
But you're already so invested with them.
You have a contract. You've put up earnest money.
Yes,
got
because
inspections.
you tried to fit into this program with them.
Yes,
and it does work out for some people. I'm not saying that it doesn't work out.
Absolutely,
it does work out for some people, and it was probably the best thing for them. And it might have been trials and whatever. But I'm not saying that it's not going to work for everybody.
No.
But majority of the time, if you don't fit into this little box and your stuff hasn't expired by then, then you're already stuck there. And now you have the other Power 5 programs that you can do.
Well, and then the issue that you have is that at that point, and this is where realtors get into really having an issue accepting certain types of loans or certain types of pre-approvals, even from certain banks, because
why is that?
Well, the reason is, the reason, but it's whenever you get into those situations, there is no accountability to anybody, right? So if it's a big bank located somewhere in America, or if it's a bank that likes to chase cars around the corner and and if you like quick banks, those type of banks, this is fun. You play this game all day. But the thing about that is that once you're into that ecosystem and you've got your pre-approval and you're pot committed, essentially is my favorite term, then there's no way. I mean, you can get out, but you're running into issues. You may lose your contract because the selling agent's like, I'm not going to extend another 2 weeks because
you're going to lose your money.
You're going to lose your earnest money. You're going to lose your inspection money. You're going to lose the money you paid for an appraisal, all that kind of stuff. And it's not, I always, tell people it's not, agents get frustrated because they're like, well, they keep calling Chase or whatever. I'm like, look, or the bank that chases you. But I keep saying it's just what people know, right? They don't know any better. It's not, they're not trying to be malicious or irresponsible or whatever. They just don't know because unless someone's holding their hand and guiding them through the process, they just don't understand that there's another way to do it.
But there are other programs. Like there are your other programs that almost everybody can offer, but a lot of people don't know about them. Like you have your Good Neighbor.
Yes.
Okay. You have your Good Neighbor one. That's for our law enforcement, nurses, teachers, things like that.
But
there are caveats. You have to be servicing in the area,
correct,
in that locality.
Yes.
So there's always rules.
Yes.
Always rules. Okay. So like for majority of these programs that are out there, that if it sounds too good to be true, where you only got to put $100 down on a house and you buy a house for $100. Yes, it is. That program does exist.
Yes.
But Uncle Sam's going to get his money one way or another. If you're going to ask, so let's talk about the Power 5 real fast.
Okay.
I call them the Power 5. My daughter plays softball, so we talk about Power 5, right? So
pull that mic a little closer to you.
So I talk about Power 5, and I consider, so you have the 5, which is VA, right? You can get a VA loan. That's for our veterans. You can get an FHA loan backed by HUD, right? USDA, our rural development. And then you have Fannie and Freddie, which
conventional
is
loans.
Yes, conventional loans, but they're two different agencies. So we separate them out. So that's our Power 5. So a lot of these programs fall underneath one of those 5 of the Power 5s.
Where's the first time home buyer loan?
There isn't one.
What?
There's not really a first time.
What?
People ask me this all the time.
What do you mean?
What's the first time home buyer loan? What are you talking about? I'm so confused. There's not a true first time home buyer loan.
I know. Sorry.
There are programs that there are programs that might require you to be
not have owned a home in the last
not
3
have
years.
owned a home in the last 3 years, but not technically a first-time home buyer program.
Right.
They're
Like
really
conventional Fannie and Freddie have an option where you can put down 3%
Yes.
instead of 5%
Yes,
if you have not owned a home in the last 3 years.
that's right.
That's perfectly allowed. But you do have to take a first-time home buyer course,
Yes.
which is like, what are they, like $75 nowadays?
Yeah, some of them are
I mean,
even
that's not
cheaper
that
or
big of a
free.
deal. Like
Yeah.
it's a small little thing that you have to do. And I think they're pretty quick. They take like 20 minutes or something.
Yeah.
They're not very hard. But that is technically a first-time home buyer loan, but it's a conventional loan that still has all the conventional rules.
All the conventional rules.
There's no incentives involved in it whatsoever. You just put down a little less money because they're trying to be like, okay,
that's all it is. And then, so like, let's talk about your FHA. So your HUD. Remember, this is the government. So it's backed by HUD. Okay.
But let me clarify something on that too, because this happens more with VA, which we'll get to in a second. But people will say, well, FHA says this or VA says that. Okay. No loan goes to FHA or to VA in the process of doing the loan. Okay. The loan is with the bank, with the underwriters and the staff that is doing the loan to FHA guidelines.
Yes.
Okay. The government, the VA and the FHA are not issuing loans. Okay. No. They do not issue loans. They're the governing body
them or
that creates the rules to guarantee that loan. So if it defaults, then the bank has coverage.
Correct.
Right. Sorry.
There are instances in VA where you do have to submit to them, but we'll talk about that in a minute. So let's talk about HUD, FHA, government loan. Okay. Backed by the government. So I always tell people, if you are defaulted on some student loan that was government backed, don't go ask for a government backed mortgage loan.
Right.
Because Uncle Sam's going to get his money.
Right.
If you already owe the government money, they're not going to go give you another government backed loan.
Correct.
Okay. Yes. But there are programs, they're not programs per se. They're just different subsections, if you will, of the master FHA loan.
Yes.
So there's options within the FHA loan.
Yes.
But that's all it is. It's just add-ons. If you want to think of it like a menu, they're just a la carte sides that you can add to the main loan. That's all it is.
The other special programs that get brought up, and it does fall into the category. This is one of these first-time home buyer loan that gets put into that category often, but it's down payment assistance. Okay.
Oh yeah.
Yes. And that is a program. So talk a little bit about down payment assistance.
Again, you will get money.
Yes.
But it will come at a cost.
Correct.
So down payment assistance, it is great. Remember, as originators like yourself, you put the programs in front of somebody who's going to be the best option for them. Right. So somebody who might not have a lot of capital and really wants to own a home and they really don't care about the interest rate. They just want to own a home for them and their family.
Great programs.
Down payment assistance might be the route to go. You get the cash, but you're going to have caveats. A lot of down payment assistance programs require you to live in the home anywhere between 3 to 10 years.
Yes.
Otherwise, you're going to pay back every penny that they give you.
Yes.
And 9 times out of 10, you're going to have a much higher rate.
Correct.
Than what your standard is. Because again, they're going to give you the money, but it's going to come at a cost and they're going to get it one way or another, whether it be in the interest rate that they're going to charge you, because nobody dictates that rate but them for down payment assistance. So it's not like, we could play with it or anything like that. There's nothing I can do. You can't even buy it down a lot of times. Now outside of our in-house, we have an in-house down payment assistance program, if you will.
Yeah.
But majority of these other down payment assistance programs, they have caveats. What they do is they slap a second. Okay. So all that means is on your home, when you own it, they'll put something on title, similar to car title. Let's say if you have a loan. So on a house, they'll slap a little soft second lien on the side.
Yep.
That basically says if you try to go do something within the time frame that you're allotted, that you're required to live in that home, you have to pay back every bit of that.
Yes.
Every bit.
Right. There's no proration. It's if you refinance it or sell it, you're paying it back.
And each down payment assistance program has different rules.
Yes.
So, and we have to follow each of those rules. Now, they all start, again, one of the Power Fives. It's either going to be a conventional loan or an FHA loan or a VA loan or a USDA loan. One of those four, it will be one of those four. So you still have to follow those rules. And then you have to add on the down payment assistance rules on top of that.
And most of them have credit requirements. So you have to have a minimum credit score to qualify. Most of them have income limits, which means that you can't make too much money to qualify for this. They don't want somebody who makes $500,000 a year, able to go in there and get this money from the government or from the localities, mostly municipals. I say government, but it's state and local governments. It's not the federal government that's getting this money. And like you said, it's not free money. It comes with a much higher rate. But what I always tell people is like, look, as long as you understand what you're getting into,
Yeah.
right? If you understand that you're paying a higher rate to get money so that you don't have to keep renting, so you can start the path of home ownership, and you understand it and it's a benefit to you, then great. They're great
Yes.
programs. Where I get frustrated as a loan officer in the business is that there's this idea in our industry, and I don't even fault, it's not borrowers, it's people that do our jobs that use these tools as advertising mechanisms to get people to make the phone ring.
Oh yeah.
You know,
Because then they get in and then you're like, okay, you don't qualify for that.
right. And it's sold as this magic pill that's going to make you be able to buy a house with no money, with no catches. And then you call. I always use the joke, and I told you this a minute ago, but I always use the joke of, back when I was a kid watching, afternoon cartoons or whatever after school was over with, there'd be those advertisements that would come up for like the local used car dealership on like channel 21, KTXA, in between Full House or whatever. And it would pop up and the guy would be like, "Hey, I'm Bobby Joe down here, Don Davis, blah, blah, blah. If you come down here tomorrow, we got this car for $5,000, no MSRP, no taxes, just get here today." And then you're like, "Oh shit, I need a car. Let's go." So you run down there and you're like, "Hey, Bill, I saw your commercial. Can I buy that car?" You're like, "Oh man, sorry. We just sold it. But
I got this one over here.
I got these other three." And again, unfortunately, like I probably would do better if I did more of that. I just can't bring myself to do it because I just want to be upfront with people. I want to be like, look, these things exist and they are helpful. And sometimes, like with the CRA programs, we have some in certain areas, Houston, Louisiana.
Yeah.
We don't have any locally here in DFW right now.
Till maybe after the census.
The census happens. But those type of things, they all come with catches, and there's no such thing as free money. There's no such thing as this, perfect program with you. If you have poor credit and you have no assets and that you're going to be able to get into a loan, if you don't fit in the box, right?
Yeah.
The little box, then it's either going to be very expensive.
Yeah.
You're going to have a really high rate, require a lot of cash, or you're not going to be able to get the loan.
Yeah.
And that's usually how it goes. So it's, I always tell people I'm kind of like I take the air out of people's sails because, they're like, "Well, I heard about all these first time." I'm like, look,
there's not a first time home buyer.
There's
loan.
not. It's
There's
not. It's not there.
There are different programs that have different requirements.
Yes.
For it, but there's not really a first time home buyer loan.
No. But the one gets, for whatever reason, has carried on forever and is barely in existence anymore, but it's still there, is like the Homes for Heroes one, where if you buy a house in a particular area, you can get it for like half price. Remember that one?
That's the good neighbor.
Right. But you have to, like you said, it has to be in that area, and there has to be houses available for that program.
Not only does there have to be houses available, so there has to be houses available.
Right.
It has to be your primary residence, obviously. 2, you have to serve in that city. Right. So let's think about that. The homes that are going to be on the market in this area might not be an area you want to be in. Maybe not.
Right.
But it's an area that you are serving. So if you're a law enforcement agent, officer, you have to be serving that locality in order to even buy there.
Right. Or a nurse working in a hospital in that area.
And for you to even and then you have to submit to
teaching in that school district.
Then you have to submit to them to get approval of what your discounted price will be.
Right.
So it's not necessarily a flat 50%. It's not like, okay, purchase price is $100,000. I'm gonna get 50% off of it. I'm just gonna buy it for $50,000. That's not how that works. You have to get it approved in order to see what your discounted price will be.
Right.
Depending.
Well, the other part of that is that is an incredibly effective loan program when there's a lot of inventory.
Yes.
Okay. But when there's no inventory, which we haven't had any inventory for 5 years, something like that.
If you go look, there's not a whole lot of houses on the HUD.
No, there's not. There's just not there. So it's.
But if you get lucky,
yes,
there are some.
Again, it happens for sure, but it's just not something that happens all the time. Because if it did, you would hear everybody getting 0 down loans, the good neighbor loan, like it would be all over the place.
Yes,
but it's not, and it's not because there's always these catches and stuff. And again, this all comes down to what we started with, in that these programs exist. They can be very helpful for a lot of people, but they're not for most people. I would say most people don't qualify for them. And as long as you understand what the program is, what the costs are essentially, and I mean cost as far as your time, your
and
money,
your consequences
your
if you don't follow it.
consequences, correct, all that stuff, as long as you understand that, then those are great options for you. But this idea that it's just this magic bullet is just not correct.
No,
and that's really the point I was trying to drive home more than anything.
Yeah.
And we have all of those options, by the way.
We do.
Every
all
single
of
one
them.
Seth, TDHCA, we have
T-Shack.
the CR loans, T-Shack, any of those programs, we have them available. There are loans.
We have our own down payment assistance program in-house.
Yes, that's right. So we have them all. They're just, as long as you understand what they're made of and what the ins and outs are, then they can be good deals.
Yeah.
So, all right. So let's get back into FHA for a second.
Okay.
Oh, there's Shelton. What's up, Shelton?
Hey.
Hey, buddy.
Miss Shelton.
So let's get into FHA. So FHA loans, these are the ones, if there is the closest thing to a first-time home buyer loan, this is probably it, right? Doesn't have any requirements for that, but it's low down payment. It's very...
conventional can be low down payment
too.
Sure,
that's true.
Because that's like, and we'll talk about conventional in a minute, because I feel like the biggest myth... Okay, we'll get there in a minute.
Yes.
Sorry.
So relatively low down payment.
Okay.
Very forgiving when it comes to credit and issues that you've had with bankruptcies and foreclosures, much more forgiving than conventional loans.
Forgiving on debt to income ratio.
Yes. The greatest thing that when I explain to buyers the difference between FHA and conventional is it really comes down to your credit score in most cases, because if your credit score is on the lower end of the scale, FHA is typically going to be a better loan for you for two reasons. Number one is your rate is going to be typically much better if you have a lower credit score with FHA versus conventional. But really it's the mortgage insurance. So with mortgage insurance for FHA is determined by the fact that you're doing an FHA loan. That's it. So if you're doing I don't know the exact number, but let's say if you're doing a $300,000 purchase price, your mortgage insurance on an FHA loan might be around $200, $220, $178, somewhere in that neighborhood. Forever, right? Yes, forever.
Forever.
As long as you have that loan.
Yes.
Okay.
Yes.
If you refinance, you can get rid of it, that kind of thing. But it doesn't go away on its own, especially if you put down the minimum. If you put down 10%, you only have to have it for 11 years, though. So there's that. Just 11 years. Only 11 years. It's fine. So, but if you do
and there's an upfront.
Yes, there's an additional charge.
Government's going to get their money.
They're going to get paid.
He's got to get paid.
Then if you do a conventional loan, the mortgage insurance is much more expensive if you have a high debt ratio, if you have a low credit score, if you have what was the other going blank? There's three things: credit score, debt. Your down payment adjusts the amount of it too. So if you put less down, you have more. You put more down, you have less. So your conventional mortgage insurance premium is based off of several factors related specifically to you.
Yes.
Whereas your FHA mortgage insurance premium is based on just the fact that you're doing an FHA loan and nothing else.
Yep.
So if you have poor credit or let's say lower end of the spectrum credit, if you have a high debt ratio, FHA is going to be much more affordable for you to do than conventional.
Yes.
And that's the biggest difference between those two.
It is a whole lot more forgiving. FHA is going to be more forgiving on your debt to income ratio, which is exactly what that sounds like. I get a lot of questions of what debt to income is. Well, what that means is how much do you make and how much is all of your debts, including the mortgage insurance, on a monthly basis.
Right.
All of your mortgage payment and all of your debts that's on your credit report into how much you make a month.
Correct. And there's a front end ratio and a back end ratio. And both of them matter.
They do.
Yes.
They do. And FHA right now does not like higher front end ratios.
What's a front end ratio?
Which is just your housing.
Yes.
Your housing compared to your monthly income of what you make gross. Okay. So yes, FHA, it's exactly what you said. It's much more forgiving on credit, debt to income ratio, things like that.
Yes. Now it has a lot more flexibility for you to be able to get a loan if you're in a situation where you've had some issues.
Yes.
It's really what it boils down to.
Comes down to mortgage insurance for the forever.
Correct.
The life of the
There's
loan
always an expense
until you get out of it.
Always a cost.
Yes. Always is.
It's no free lunch.
But like I get a lot of agents that call me. It's actually funny because I had an agent call me the other day and was like, "Hey, can we get an updated pre-approval for your loan officer that doesn't have FHA?" And I was like, "Why?" "Well, we're just really afraid about the appraisal." "Why?"
Yes.
"Why?" Value is not determined by program.
No.
Okay.
No.
Your program has nothing to do with value of the home.
Right.
Your value It's going to come in at value depending on the comps in your area. You could line the whole house with gold. I really don't care. But if your house next door, who looks exactly the same to yours, was in foreclosure and it sold for way less, well, that's going to be part of your comps.
Well, and I don't know if, I mean, I think most agents maybe realize this, but maybe not everybody. So I'll just say it. But when you do a purchase, it's different than a refinance. But when you do a purchase on a home, we have to provide the purchase contract to the appraiser.
Mhm.
It's required. We have to
Mhm.
get, they won't even go out there until they have the purchase contract.
Mhm.
Okay. So what that means is
And you have to have a case number too for FHA.
Yes.
The reason being is just piracy. And some people don't know that. And that's because what's to stop Joe Schmo from going out and ordering a case number, which is just an identifier number for HUD, okay,
Right.
for that property, because they want to be able to keep track of every property that's going to be insured by them. And so what's to stop Joe Schmo from going out there and ordering case numbers on 50 million properties? So we have requirements. You have to make sure that you have an application on that property and a contract before you get a identifier number for that property. And then you have to have an approved appraiser for FHA to go appraise the property.
That's right. And when the appraiser goes out, he has a copy of the contract. So the good thing about that is they have a target. They have a number that they're shooting for.
Yeah.
And what I tell every agent is, look, if it comes in at value, because you get that a lot, like, oh, this house is supposed to be this much or worth that much. I'm like, what did you sell it for?
Yeah.
Well, I sold it for 300. Okay, well then it came in at 300, so we're good. They're like, well, it's probably worth 310. There's no incentive whatsoever for an appraiser to give you over what the value of the home is. Okay, there is zero incentive for them, right? But that means if you actually get an appraisal where it is more than what you're purchasing the home for, it's probably worth quite a bit more than that.
Yeah.
And you could probably sell it for more, because again, there's no incentive for the appraiser to give you more value.
That's right.
They have zero incentive. So they're not going to. There is incentive for them to give you lower value because they don't want to get in trouble for overvaluing and misvaluing properties, because they do get graded on this type of stuff. Can you turn your clinks off or whatever you got going on over there? Like, can you mute?
Did I clink something?
Well, no, you're like,
yes. Sorry.
Your Teams keeps popping up.
God.
Sorry, technical thing there. But when you look at what appraisers are incentivized to do, they're not incentivized to give you higher value. They're incentivized to give you a lower value because they don't want to get into trouble. Now, it isn't something that they're going to, because trust me, if the value comes in low, I know we do. I can't speak for everybody, but we are going to fight that value tooth and nail with every way that we can to get it to where we can qualify. We're going to get comps from the realtors. We're going to get, we're going to run
newer listings if we need to.
Yes.
Yeah.
We're going to get something called collateral underwriter that's going to run the property to see what it values it at, which is just basically like I don't want to call it AI because it's not really AI, but it's like an algorithmic program that evaluates other houses that have sold in the area and creates its own version of an appraisal, which are pretty accurate these days. So appraisers, watch out. But we use all of those methods to try to make sure we get to the value. And again, if you want to look at incentives, the appraiser, Mr. Joe appraiser, who's just doing his job, going out there every day, he doesn't want Jen Gaudio and Mike, well, I can't call him, but he doesn't want the appraisal desk for Verity Mortgage blowing up his phone for 5 days.
He shorted me $5,000.
Right.
So he doesn't want that. He's going to appraisers will do everything that they can.
Do the best job they can do.
And look in the area to try to hit that target that they can. If it's vastly off, there's a reason why.
So speaking of the appraisals with FHA, what is it? I'm asking you questions you know the answer to, but
there are some weird things about FHA. Okay. Like peeled paint.
Yes.
If it's, let's say you got a shed out back and the paint's old and it's cracking and it's peeled, FHA doesn't like it.
It's a safety thing.
It's a safety thing. They don't like it.
They
want you to peel. They want you to, they want you,
water.
They want you to sand it down, repaint it. Okay.
Yes.
That's something that they just want. A fascia.
Yep.
Fascia replacements. Like these are just
exposed
minor
wires.
Yeah. Exposed wire, like fascia, soffits, like those things, they want it replaced.
Safety issues.
Yes. Those are safety things for them.
Yes.
So they're a little bit harder on those things. Surplus land is a big one.
Yeah.
Excess land is what they consider it.
Okay.
So that's a big one with FHA.
Explain what that means.
So it has to, there's a lot that goes into the surplus land calculation, but for FHA, basically if you're buying a home that's on 40 acres.
Right. Mobile home.
Sure. A mobile home on 40 acres.
Excuse me. Manufactured housing.
Yes. Manufactured home.
Sorry.
That is a lot of excess land.
Correct.
So
there's a lot of value in the land.
There's a lot of value in the land.
And not necessarily a ton of value in the house.
The home.
Right.
And so what FHA does is they basically make you look at the surplus land, is what they call it. The appraiser has to address it. What is the highest and best use of that land? Is it commercial? Is it residential? Is it being used in the highest and best use? And then if it is kind of pretty much, and it's not common to the area too,
Right.
let's say, then they might have to count that out of the value.
Right.
So yeah, there is a little bit more rules to that. And then there's other rules like that are for FHA, not just, I mean, I guess it could fall into the appraisals too, but about flipping. So there are flipping rules. And all these rules, by the way, are really there at the end of the day
Protect the buyer.
to protect the buyer.
Yeah.
That's what all these rules are there for.
Yeah.
They're to protect the buyer, to make sure they're not getting screwed up and
Yeah.
out of a bad deal or something like that, right?
So you brought up flipping, which is a good one. So especially related to FHA. Talk a little bit about that, because there used to be, and this is because this thing moves all over the place all the time. There, many years ago, there was the flipping rule, and it was 90 days or less. Wasn't that basically what it was? I know that there's rules for different times, but then it switched, or it moved, or maybe it was 6 months, and then it switched to you couldn't do it, period, for less than 90 days. And then it became, well, now you can do it in less than 90 days, but there's these stipulations. And then it switched back to you can't do it at all in less than 90 days. And if it's less than 6 months, you have to do A, B, and C.
Yeah. And it used to also be like data. It used to be date off of date of recording.
Right.
For your time clock to start. So the newest and latest is sub 90 days is not good.
Now, by the way, hang on real quick before you go down this hole. So this is something I wanted to mention earlier. So right now, Jen has her laptop out and Jen is typing this in and trying to figure out exactly, because she's terrified that she's going to give the wrong information.
It changes all the time.
No. This is a good thing. This is a good thing.
Like, it's going to change again in a month.
Right.
Yeah.
So
FHA's handbook is going to change again in a month.
So my point of this is that the reason I love Jen, and I always go to Jen for these questions, is because you and I are very similar in that
I don't want to be wrong.
Right. Well, absolutely. Like, I don't want to be wrong, but I always hedge my bets. I always say, here's what I think. Here's what I'm pretty sure it is, but let me double check. Because man, we just get shit wrong all the time. And I don't mean like that sounds like we don't get shit wrong all the time. We think
it's because it's ever changing.
Correct. It always moves.
And sometimes we don't get so if you're subscribed to your Power Fives, you'll get some of their updated stuff that they come out, but sometimes they sneak some shit in there and you're like, I had no idea.
Yes. Well, it happened to us
last week.
Yes. So the other day, last week, I got a call from a client and he had an investment property that they were repairing and fixing. And he called me and said, hey, Mike, we're about done with this, but we want to look and see what our options are for refinancing this. And we want to take equity back out. So basically, let's just say they bought it for $100,000. They put 50 grand into it. It's now worth 300 and they want to get the excess equity because they want to do it again. They want to go buy more properties with the cash that they, picked up from the equity. It's a cash out loan. So he says to me, and I'm like, yeah, that's no problem. As long as you've owned it for 6 months, then you're good to go. And there's stuff with appraisals and showing the cost or whatever. So he texts me back and he's like, hey, my son was talking to another loan officer and they said that he said that conventional loans are switching on April the 1st to where you have to own the property for a year before you can do the loan. And I said, well, there used to be a rule where you had to own it for 12 months to do a cash out. Because at first we were talking about rate and terms, what we were talking about. And I said, that's a cash out rule, but it's actually 6 months. It's not 12 months. You just have to have it for 6. And he's like, oh, okay, cool. Yeah. And I was like, and I even was like, sometimes people don't, the banks have their own rules. And I wasn't talking trash about the guy that gave him that information, but I was just like, not everybody can do everything all the time, but we're pretty good. Yeah. Right. So then I call you. Yeah.
And one of them had changed.
Yes.
Of the conventional.
Yes.
But the other one hadn't followed suit.
Right.
Yeah.
So I called. At the first time I called you, I was like, hey, have you heard this? And you're like, no.
Oh yeah. Wait, what?
Yeah. You're like, no, that's 6 months. It's always been 6 months. And I'm like, yeah, that's what I thought. We're both just like, yeah, we're right. Yeah. We're both right. Yeah. Right. So then I text the guy back and I'm like, hey, you're good. I double checked, we're fine. Yeah. 6 months, whatever. Then he texts me back, I don't know, an hour later. And he's like, hey, I just want to make sure because we're here.
And then we get notification.
Yes.
That
Well,
Freddie.
no. So it's funny because then I call Brian and I'm like, hey, Brian, I talked to Jen. She said this is what's going on. I said, he's like, oh yeah, well, hang on. He did a little digging and he's like, oh yeah, sure enough, man. Fannie did change theirs. It's in here. It came out. It was like, I don't know, 3 or 4 weeks before that.
Yeah.
And he's like, we just missed it. And I was like, well, it'd be nice for us to know.
But Freddie hadn't updated yet.
Correct. And he said, but Freddie, you can still do less, or you can still do 6 months. And I'm like, sweet. Okay. So I text the guy back again and I'm like, hey, Fannie, that guy was right. Absolutely. But Freddie, we're good.
And then Freddie followed suit
that day.
They followed suit that day. And now it's like, no, can't do 12. Okay. Back to property flipping.
Sorry. I had to just, that's just an example.
It changes all the time, guys.
Yes.
Okay. So property flipping. Yeah. So FHA, basically, again, they want to protect the buyer. So in the property flip, sub 90 days. So basically what that means, and it's based off of the acquisition date. So if I bought a property,
the funding date, basically
the day that I sold it,
right?
The day I signed,
right.
From that date to 90 days, I can't execute a contract, FHA, to a new buyer.
Right.
Okay. Day 91, I can.
Correct.
But there are rules.
Yes.
So if you're between 91 and 180 days, I have to prove one of two things. I either have to get a second appraisal to justify the value that you're selling at, or I have to prove that the seller is not selling it for more than 100% than what they bought it for.
Their acquisition cost.
Yep. One or the other. So there's still rules. And so you can still do it within the 91 to 180 days, but there's just rules inside.
Well, and it's a good thing for agents to understand when you're listing a house that is from an investor that has flipped it. Okay. Everything in our job is about expectations. So when you're listing your property, if there's an opportunity for you to accept an FHA offer, if that becomes a possibility, then you have to let your seller know, hey, look, you bought this house, we're going to sell it on this day. We can accept FHA offers on the 91st day. But if you're okay with us providing to the bank your acquisition cost, because we don't, like, when we get that from the seller, we're not giving it to everybody. Like, it's just so we can show underwriting and HUD that they didn't, if they bought the house for $100,000, they're not selling it for 200.
Well, I know, like, Susan, when she had listed ours, she put on the description, eligible for FHA financing on this date.
Right.
So we didn't have a bunch of offers coming in that were stuff that weren't eligible.
Well, because sellers will get upset especially with an investor. I mean, I've had it happen where, I asked the agent, hey, I need to get their acquisition cost. Can you send me the HUD or the closing disclosure? And they'll say, oh yeah, no problem. And then they reach out to their seller and then the seller, well, that's none of your business. What I did. And it's like, I understand, but you chose to accept an FHA offer. And when you do, there are certain rules that come along with it if you're selling it in less than 6 months.
Yep.
And they end up being fine with it. But it's just, again, creating the expectation as a listing agent to make sure that your seller understands what could come if you're doing an FHA loan.
Yep.
Right. One other thing, and this will kind of be, this will be conventional and FHA, but I want you to talk about our favorite thing, which is the bane of everyone's existence in the mortgage world, and that's assets, because assets are so fun.
And there's so many different, there's so many different not ways to get around, but there's just so many different options.
Yes.
Okay.
Yes.
I think that's the best way to put it.
Correct.
Because each of the Power Fives have their own requirement on assets.
And real quick, before we go there, so when we're doing a mortgage loan, we're looking for 3 basic things. Okay. Credit, your income, okay, your debt to income, and your assets. Those are basic. I mean, you got the property, you got collateral.
Yeah, you have some salt in the game.
Right. So your credit is very much black and white. Either your credit qualifies or it doesn't. Mm-hmm. Now, if it barely qualifies, then there are extra hoops. You have to have stronger assets, stronger debt to income ratio. You've got to have, of those 3, you better have 2 pretty strong ones in order for one of them to be weak.
Yeah.
Right.
Yeah.
So credit is, but it's still either it's there or it's not. Right.
Yep.
Debt to income is probably where we spend 80% of our time.
Yep.
Right. Figuring out how much income somebody makes,
how much house you can buy.
Correct.
That's the whole basis behind the debt to income. How much house can you really buy?
And we have to verify your employment. We have to verify your tax returns, tax transcripts, calculate your income based on commissions and overtime and averages and all this stuff. Right. And look for all the debt. You got your credit report, but then do you have any court order debt? Do you have divorces? Do you have tax liens? Do you have any of these things?
Do you have debts popping up on your bank statement?
Did you not pay your student loans?
Didn't tell me.
Right. So all that goes into play with debt to income. That's where we spend most of our time as far as doing the detective work.
Yes.
Right.
Yes.
But the part that is either the easiest or the hardest
is
the assets.
Is the money.
Because all you have to have in most cases, not in every case because there are reserves and things of that nature, but for the most part, you just have to have enough to get the house, right? Just enough. If you need $20,000 for your down payment or closing costs, you just need 20.
Majority of the time.
You don't need 21, you don't need 25, you need 20. Okay. The tricky part comes into where is it coming from?
Where's it coming from?
And
what's going out of it?
How many places has it been before it got?
Where's it going out? So if you are in the home buying process, it just makes it a lot easier if you just have one account that just has all your savings that's already in there.
Yes.
Now, each of the Power Fives have their own rules of what, because we have to analyze your bank statements, right? If you're going to give me bank statements, I have to look at it and ensure that there are no other possible debts, that there's no, that you're paying out for somebody else or co-signed on another loan, or because remember, I'm trying to make sure your debt to income ratio is in line and that I have calculated all of your debts based off what you make. So if your bank statement shows a payment to the IRS and I don't have your tax returns in here, well, now I'm gonna have to ask you about it. So we analyze everything that's on your bank statements to ensure there's no other debts that you're paying out.
Right.
And then I gotta make sure, I also have to analyze your deposits that you have putting in. Well, a lot of people, and totally understandable, but a lot of people save a lot in cash. It's more common than not, which is totally fine.
Yeah.
You want to keep it in your safe, whatever.
Right.
But the problem comes to be when you go to buy a home.
You got to prove it.
Because now I don't know where you got all that money from.
Right. And why, and can you, to the best of your understanding, can you give an explanation as to why we can't accept cash? What's the justification for Fannie Freddie HUD to say why they're not just okay with some? Because if I got the money, I got the money, bro. Right.
Well, I don't know where it came from.
Exactly. But why do we need to know where it came from?
Was it a loan?
Right.
Was it
a loan? Or
was it a loan? I don't understand.
Or did you get for Jimmy the loan shark down there that you're going to own a bunch of money to?
Yeah.
Did you get it? You know, they couched it initially when they really got onto it is about they didn't want, I want to say foreign money, maybe drug money, whatever you want to call it, laundered money. Probably.
We don't know where it came from.
We don't know where it came from.
So, you know, if you know you're going to be buying a home in the year, just go put it in your savings account. Like, go put it in. If you got some cash, go put it in.
Yeah.
Because large deposits we have to analyze, and each of the Power Fives have their own rule. So it's kind of weird. Like, and I don't understand the rhyme or reason behind the different rulings of it. We just have to follow what that particular agency. I don't write the rules. I just have to follow them. Okay. Yes. So, like, for example, for your conventional loans, it's any single deposit over 50% of your qualifying income. So if I'm only using $5,000 a month to qualify, even though you make $10,000 a month with commission and all that, but I'm only using the $5,000 for income, well, then any deposit over $2,500, a single deposit, I have to source.
Right.
And I have to document where you got it from. But if it's under, then I don't care.
Doesn't matter.
It's kind of weird how each of the agencies have their own interpretation. For FHA, it's 1%, anything more than 1% of the sales price, I have to go source. For VA, there is no rule. For VA, they just look at the veteran's assets as a whole.
Yeah.
Okay. For USDA, every deposit has to be analyzed, whether it's $50, $10, that's non-payroll. And the reason for that is because USDA is income based.
Right.
They have income limits. And so they want to make sure the money that you're getting is not coming from an additional income source that we don't know about.
Right.
Right. So yes, assets is, it's tough because people don't understand sometimes why. It almost feels like you're getting really personal and diving really deep.
I mean, it's their bank statement.
I know. And and you almost feel like sometimes you're like, man, I know this feels like we're almost interrogating you. I'm sorry. But this is just a rule I have to go by because I see the same charge going out every 2 weeks to the same person.
Yeah.
What is this?
Right.
And I have to document it because we have to make sure that you qualify for your loan.
Yeah.
And that you're going to be comfortable making your payment.
Right.
And if this is truly your debt, you might not want to have this much of a house buying power,
right.
you know? And we have to cover the rules too. So yes, there's that as far as assets. So my suggestion, and then also, you know, I saw this TikTok the other day that if your lender asks you for 2 months bank statements, the general rule is 2 months.
Correct.
Okay. Now, when it comes down to it,
conventional loans are 1, right? 30 days?
Only Freddie.
Only Freddie. Oh, that's right.
There's different rules. So Freddie conventional is 1 month. Refinances is 1 month for both Fannie and Freddie. FHA VA is 1 month. As long as the statement, the the statement has the previous endings balance from the previous month.
Right.
And then USDA is 2 months. So everybody has their own rule. So the reason that we always ask for 2 months up front is because we don't know at that point in time while we're qualifying you to try to figure out what is the best loan program for you
Right.
of the Power of 5.
Yes.
So let's go ahead and cover all of our bases and let's just figure out which one we get the 2 months. We can figure out which one you're going to fit into. But we might only need the one.
Well, that's where we get a lot of complaints from borrowers sometimes, and maybe even agents to some extent. I don't say we, I just as an industry, where people will say, well, they asked me for this, and then they asked me for this, and then they asked me for this, and then they asked me for this. And that gets frustrating because from a borrower's point of view, they're like, I just want to give you everything. But what loan officers get scared about or don't want to do is they want everything to be easy as possible. Like, I don't want to ask you for too much because I don't want you to call somebody else and do the loan.
Because they're going to ask you for less.
Right.
But then they're going to ask you for more later.
Right. And it's like, well, if you just, the thing, if you're a loan officer and listen to this, like in the beginning, the people are the most excited about buying a house.
Yes.
They've got the most energy. They're ready to go, whatever.
They're going to give you whatever you want.
Ask them for everything you might need.
Yeah.
Even if you don't need it. And the reason being is because they get frustrated as you keep asking them for more things and more things and more things if the loan program changes or you have some adjustments that you have to make. And B, their expectation of how the process is supposed to go from the very beginning of what you're asking for is that it's going to be, okay, well, here's all my stuff. Right.
Yeah.
And if you don't explain to them, hey, I'm going to ask you for everything, but I always tell people, like, I'm the attorney. I'm not the judge, right? My job is to help put together the best possible loan situation for you with the least amount of headache and paperwork and everything else so I can move forward. But in order for me to do that, I need to get all the information because then that tells me, well, I can't go this route because if I go this route, then I'm going to have to give them another tax return and that could cause a problem. So I'm going to stay here in this lane because this is the best lane for you to get the loan.
Yep.
We're following the rules. We're doing exactly what's required of it. So we're just trying to find the most efficient way for you to do it. Yeah. So if I get as much information from you as I can up front, then I can make a proper diagnosis like a doctor and put you in the best loan.
Yeah.
But if I try to nickel and dime you to death with, I need this bank statement, I need this tax return.
This one didn't work. Okay, we're gonna have to go this route. Let me go back. Yeah.
So then people go nuts and realtors get frustrated, buyers get frustrated. Our goal with our company is we want to ask them for stuff twice.
Yeah.
2 times. We want to ask you upfront everything to send us. And then once the loan's approved, once we have what we have, then we want to ask you a second time for stuff to clear. Because there's always extra stuff that happens. I mean, it's just, there's not a whole lot of loans that go through. There's some, it happens. But if people have really simple situations, but there's not a ton of loans that go through that the first time you submit it is closed and good. Right. Yeah. It happens for sure. If you're W-2 to have all your money saved up, all that kind of stuff.
Self-employment's great.
Yes.
Okay. Back to assets. So you have gifts.
Yes. That's the other part I want to ask you about gifts.
Those are different rules too.
Yes.
Because who can give?
Right. So gift funds, by the way, are money that you can get from someone else. Okay. Primarily, I mean, there's very few circumstances where it's not a family member. Right.
Well, FHA allows for employers.
Okay. But what I'm saying is you can't get it from your neighbor.
Unless it's an FHA loan and that neighbor has a vested interest in your home purchasing as a close friend.
Right.
Like there is so many rules on top of that. Yeah.
Right. On average, though, it has to be pretty much a family member. You can prove other things, but you better be really documented.
Family member.
Yes.
Yeah. Mm-hmm.
Yeah.
But your friend's not going to work.
Correct.
Unless there's a vested interest, like it just goes on.
Yes.
So yes, gifts are, and there's, again, with the Power Fives, there are different rules of documentation of gifts. Conventional, because it's not government backed, there are things that conventional loans are a little bit more forgiving on than your government loans.
Right.
So on your conventional loans, I don't really have to source. I don't have to go call your donor, whoever's giving you the money.
Let's say it's dad.
I don't have to call dad and say, Dad, give me a copy of your bank statement.
No.
I don't have to do that. Dad can just cut a check straight to the title company if he wanted to, and a copy of the gift letter stating that this is a gift and be done.
But on the gift letter, just so you know, there are questions. What's your name? What's your address? Mm-hmm. What's your phone number? And what's the account number? Uh-huh. Okay. I've run into issues before where mom and dad, even on the gift letter, have much less given a bank statement, which you got to, FHA, you can explain that one. But mom and dad have an issue even just giving the account number because they think the internet's going to steal their information, which I understand. But these days, if they want it, they can get it.
Yeah.
But that's the thing too. The gift letter does have a little bit of information on it, but if you just have a gift letter signed by the donor and you have a copy of the transaction, whether it be a wire or whatever it is that matches certified funds that matches the account number and the name, then you're golden.
Yeah,
you don't
have
need
to get
anything else. Right.
Government loans, however, are different.
Very different.
I have to have a bank statement.
Actually, back up on the conventional loans. What about if I want to give money to my daughter, but I want to put it directly into her bank account? Instead of
So on conventional loans, it's still okay.
Okay.
I don't have to have, again, none of the scenarios for conventional loans for gifts.
Okay.
And that is not allowed for investment properties, by the way. But none of the situations for gifts on conventional loans do we require or agency requires a bank statement from the donor.
Okay.
If they decided they wanted to put it directly into daughter's bank account, then I have to have a copy of the withdrawal slip and a copy of the deposit slip along with the gift letter. Okay. That's all it is.
Right.
So it's much simpler
with conventional.
On conventional.
Yes.
Yeah. When you get into government, it's a little bit different.
Okay.
So you have to provide bank statements from the donor. And we get a lot of pushback on that.
None of your damn business.
It sucks because we don't make the rules. Like, it sucks. I don't make the rules. I'm sorry. It clearly says right here, I have to provide a bank statement for the person who's giving you the money. And what really sucks is that on government loans, if they had a large deposit that's in there, that's totally fine. Like if mommy and daddy went and got a 401k loan to help their daughter buy a house, there's not a problem with that. We don't care where the donor got the money, except when it's cash.
Yes.
So if the donor had a large deposit that was cash that I can't take it out, back it out, then I'm going to have a problem. But if they got a $10,000 loan that they're the one that's the obligators on, I don't care. No. Mom and dad can go get a loan. They're not the one that, to give their kids money. That's fine. Yeah. But yes, we do have to have a bank statement on government loans.
If I had a nickel for every time I had.
Except for USDA, because remember, USDA is a conventional loan that just happens to be backed by the government.
I didn't know that, actually. Okay. See, look at this.
Just USDA.
Dropping nuggets of knowledge over
USDA,
here.
you actually don't have to have a donor bank statement.
So USDA is a conventional loan?
It's basically a conventional loan.
Oh, because the rules are similar by conventional is what you're saying.
Well, actually, no, some of the rules are actually more in line with FHA, but it's technically a conventional loan just backed by the government. Huh, but they follow a lot of FHA guidelines.
Okay. We're all right. I was going to say, if I had a nickel for every single time I had an angry grandpa or dad call me and literally cuss me out over the phone because how is it any of my damn business?
And they used to, in the guidelines back before the 4155, we used to be able to just get verification letters from the bank. Like Mike Mills has been a member of ours for 25 years and has had more than enough money to give his daughter. Yeah. Blah 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 blah. Yeah. Can't even use those anymore. They changed those. They updated it to make sure it says.
Yes.
Got to get it.
Yeah, it's we're running out of time a little bit, and I know we didn't get to everything. No. This is great. This means we got to do it again. I think this once every couple of months we'll do a little mortgage update. You could
spend a whole thing on self-employment.
Yes, it takes forever. Ooh. Maybe we'll do one just on self-employment. Yeah. I think that'd be good. But the thing about all this is, to kind of put a little bow on some of this stuff, is that if you look at what's happening right now in the economy, okay, we are going through all kinds of stuff right now, and it's different today. Like the whole recession or banking crisis really is what's going on right now. Has nothing to do with real estate. Mm-hmm. Not like it did. There was another banking crisis that happened in 2008 that had everything to do with real estate. Mm-hmm. This particular one has very little to nothing to do with real estate. It still impacts it in a number of ways, but has nothing to do with it. So the rules on getting a loan these days are so I don't want to say
they're not harder. It's just, I think the situations, no two loans are the same.
No.
None. No. But I think that what we are finding is that there are so many new situations that we've never actually really came across before. Couple that with agency changes based on this particular market that they have updated the agencies have updated their rules, that now we're trying to find a little bit more creative ways to fit these borrowers into those Power 5 loans, because they have updated based on the market as well.
Yes. And that's where I made a video this morning about how it's weird because the banking crisis that's occurring today, it's not going great because the government's saying they're going to bail out Credit Suisse, I think is what it's called, and all these others. So that's a whole other thing. But if that continues, if we continue to have more and more banks running into problems with their deposits because they've made bad investments, then you'll see people start taking their money out of the stock market, which will cause the stock market to crash. Yeah. And then if the treasury yields keep falling like they have, people are going to take their money out of that and they're going to put it into bonds along with the people that are pulling their money out of the stock market. Well, this is great for mortgage rates. Like it really is.
Yeah.
And it's like a perfect storm of situations that in 6 or 8 months from now, we could have really low mortgage rates and the Fed had nothing to do with it.
Yeah.
Like it could happen. Now, it's not good for the rest of the economy.
Yeah.
It's bad for people losing their jobs. It's bad for small businesses. There's a lot of negative things that are going to come from this if it keeps heading in the direction that it seems to be heading right now. Mm-hmm. But the safest place for investors looking right now is to put their money is into mortgage-backed securities that are that have been there for a while, because these rules and restrictions and guidelines have been so,
they've been tweaked a lot.
They've been tweaked a lot that
I mean,
our foreclosure rate's next to zero.
Yeah, they have been tweaked a lot. Like if you qualify for a mortgage now, you qualify for a mortgage. Now it's still forgiving.
Yes.
There are still programs that are still very forgiving.
Sure.
And I'm telling you what, sometimes I look at a loan and I'm like, wow, I can't believe we're actually doing this.
Yes.
But the borrowers on the other end are absolutely incredibly grateful, and that's what makes it all worth it.
Yes.
But you kind of look at it from a overall, and you're like, oh wow, that's credit's not looking great. Yeah. Money is slim to none. Yep. Income's barely sketching by. Yep. So I mean, we're gonna make it work one way or another. But at the end of the day, all these Power Fives. So not only do we have to follow these rule books, right, and they're legit books.
Yes.
Legit.
Yeah. Websites now.
Yeah. Now you can control.
It's not like a big,
Now you can control that. Well, they still sell MRI.
Oh yeah.
But so they're just massive 1,000-page books of rules. That's all it is. So not only do we have to follow these rules, we then have to enter all of this into a magical automated underwriting software that every agency requires. Everybody out there runs it, and it has its own little quirks.
Fun little quirks. Yes.
And so to me, we're like, okay, well, we fit every rule. We fit every rule here. But then I run it to this magical underwriting system, and there's something about it doesn't like. And so at the end of the day, you still have to have that approval as well.
Well, and that's where I try as much as I can when I deal with agents. And I think we do a great job as a company doing this, to where you have to have a very knowledgeable loan officer that knows what they're doing. Because this whole concept of where we started, which was, the loan's been in underwriting, I'm waiting for the underwriter to tell me what we can do. It's complete bullshit, because the truth is that if you know the rules and you know what you can do, we run the automated underwriting system before the loan ever even touches the underwriter.
Yeah. And education is key.
Yes.
This is the most expensive thing somebody's going to buy
Correct.
ever in their life.
Yes.
So I think that the unknown is what makes buyers apprehensive.
Right.
So if you're dealing with a ginormous bank in America, that's awesome. That's totally great. You don't have to call Mike Mills. That's fine.
What are you talking about? Call Mike Mills.
But are they spending the time to educate you through the most expensive purchase that you're going to make in your entire life?
Right.
Do you feel uneasy about what's going on?
Yes.
Do you know what's going on? Do you know why you have to do this? Do you know why we're asking you? Or, so again, it kind of feels like interrogation, but I feel like buyers are so much more easy to not only provide stuff, but they feel a whole lot better about the loan process because we educate them. You know what I mean?
Yeah. Well, I mean, you just want to feel comfortable. This is a big thing. It's a big purchase.
It's huge.
You got to be comfortable.
I just turned 36 yesterday, but
happy birthday, by the way.
Thanks. But I feel like the average home buyers now, I feel like the millennial age of home buyers, they're waiting to buy, I feel like. And so now if you're in your early 30s, I feel like that's when they're actually buying now.
Yes. No, they are. I read something the other day. The average home buyer now is around 34 or 35 years old.
See? And so at this point, well, hell, they're in their mid 30s about to buy their first home.
Yeah. And
it's a huge purchase, which means they've been stacking paper for a minute, trying to prepare, and they want to know every process. Well, you're not going to get that from... You're not going to have a loan officer.
A big bank in America.
No, you're not. You need somebody like Mike Mills. You need somebody if you're in Louisiana, you need somebody like our loan officers here, because we're going to sit down and we're going to educate you on what it is.
Yeah.
That's the biggest thing. These rules are different because the Power Fives govern us. We have to follow the rules. Where you fit within those programs, There might be somebody that says, okay, we're going to put you into an FHA loan, blah, blah, blah. It's going to be a great rate because you're so rate conscious. But that might not be the best program for you, my
It
dear.
might be the lowest payment, because if you have really good credit
Yeah.
and you have a low mortgage insurance premium because your credit's
Yes.
great and your debt to income's low, then why the hell would you do an FHA loan?
Exactly.
Yeah.
Like that might not be the best program for you. Sit
Right.
down, get educated, talk to somebody who's going to educate you through the process.
Yeah. And that's the thing. It's just one of those things that when you do this loan, because it is such a huge transaction, it's such a big responsibility, that you got to feel comfortable in the process. You got to know that the person that's presenting your attorney, right, that's presenting your loan to the judge, knows what they're doing. Because if they don't, then you could be in a situation where you don't get your home approved. And most things, there's always exceptions. And Jen and I, if you ever talk to us, we will always put caveats on. I don't know. I think, but I don't know. I'm pretty sure that this is the answer, but
let me just go call the agency myself.
Let me check. But you have to know that the person that's handling that knows what they're doing.
Yes.
And knows, because there's very, very few circumstances, it happens, but very few circumstances where the loan that gets denied wasn't probably denied before it even touched the underwriter's desk. Mm-hmm. Right.
It's funny, your analogy that you use about attorneys. I've always used, because I'm on the operation side, right? I've always used, think of it like, my analogy has always been like a staffing company. Okay. The buyer is somebody who needs a job. Mm-hmm. They come to the staffing company, which is us. Yeah. Or you. Okay. The staffing company and your processor. Typically, there's a loan officer assistant and a processor. Okay. So you'll have these people at the staffing company who are putting together the best resume that they could possibly can. And after they put the resume together, then they go present it to the job where they're trying to get you hired full time, which is the underwriter. Right. So they're trying to put the best resume together possible. So the more we get up front, the more answers we get up front. And I feel like we're going off on a whole nother tangent, but as far as qualifying for a loan, I feel like sometimes buyers get hesitant on saying certain things or telling certain things.
Oh, right. Well, that's why it's attorney-client privilege, baby. Tell me everything.
Yes. Because if you tell me what's going on, if you tell us what's going on, there's always going to be a solution. Yeah. But if I find out after the fact, it's going to be way harder. Yes. Let's head it on up front. Be honest with us up front and tell us everything that's going on so that we can figure out how to fix it, so that just like you say all the time, so that I can head any problems that are going to happen up front before later on when you're very invested into this. Yes. And in love with your home.
Well, it's a common thing. Buyers get nervous about filling out an application. I wish that wasn't the word.
Yeah.
I wish it wasn't an application. I wish I could come up with a better word, because it makes it sound like it's like you're applying for a job.
Yeah, like I'm putting it in and oh my gosh, if I did it wrong.
If I did this wrong, then I'm going to get denied like in 5 seconds. It's like, I try to look, no, it's not what it is.
Yeah.
We're just gathering your information through this form that you need to put it in to fill it out, call it a Google Doc or whatever, right? Just need to fill it out so I can get the information. Then once I have the information, then I can make my diagnosis. And then I can say, okay, here's what we need to do. Here's where we need to go. Here's the documents I need. Here's all that kind of stuff. Because again, I want to do this loan just as bad as you do.
Yeah.
Okay. I want to do it too, because this is my job. This is your job. This is how we pay our company. We want to do the loan, but we got to figure out the best route to do it so we can make it easy for you, make it easy on your agents, make it easy on your family.
Yeah.
So
tell me where your money's coming from. Yeah. It's okay if it's going to come from your wife's account.
Okay.
No problem.
Yeah. We'll figure it out.
That just might have to be a gift if your wife's not on the loan.
Right.
We just need to know so that we can tell you what documents we're going to need up front. If the money's going to come from some massive grant that I have been seeing a whole lot lately, from VA for some reason. People are getting grants.
Like to veterans?
Yeah, it's crazy. I don't know all the deets, but this is like the third or fourth situation now where they're getting pretty big, substantial. I don't know what they're for, but we have to be able to document it. So just tell me where it's going to come from. If it's going to come from a retirement account, is it yours, or is it in the care of somebody else, or is it from a trust, or all it is I always tell people, whatever you put on the application, just be prepared to prove. Okay. Yeah. Whatever you put on the application, be prepared to prove it, because we're going to ask you questions about it and we have to document it based off of agency guidelines.
Right. Right. All right. Well, we just started quick and we're going to end quick because it's an hour and 10 minutes in and you've got a lot of work to do and I've got a lot of work to do. So I really appreciate you taking time out. I'm sure you'll get stuff from Steve later because he'll be real thrilled that you spent an hour talking about loans with me, but this is marketing and advertising and you're helping out one of your branches. So I really appreciate it.
It's great. I think it's good knowledge for people to have.
That's right. So thank you everybody that stuck around and watched for a little bit. If y'all do have questions after you watch this later, put them in the comments and we'll probably do this again because I love talking to Jen. She's one of my favorite people.
It goes by so fast.
It goes by so fast.
And you're like one of the smartest people ever.
Thank you for saying that. But we all know that that's not true. So, all right, guys, y'all have a good weekend. Stay dry. We'll see you next time.
Bye.